Hi everyone, and welcome to Property and Casualty Insurance Fundamentals. In this course, we're going to break down the essential concepts that drive the entire P&C industry, from how insurance works, to underwriting, valuation, policy structure, and real-world coverage mechanics. Let's get started. Core insurance principles. First, we have insurable interest. This simply means you can only insure something if its loss would cause you a financial hit. If you own a home, a car, or equipment, you clearly have an insurable interest. If a bank lends you money to buy a property, the bank also has an insurable interest, because if the property burns down, they lose money too. But here's the key rule. Insurable interest must exist at the time of the loss, not just when you bought the policy. So if you sell the house and forget to cancel your insurance, and later a loss happens, you get nothing. You no longer have a stake in the property. Understanding this principle protects the industry from fraud and aligns with the core purpose of insurance. 2 is the principle of indemnity, one of the most important ideas in insurance. Indemnity means insurance is designed to put you back where you were financially before the loss, not ahead. Not worse off. Exactly where you were. If payouts exceeded the actual financial loss, people would have an incentive to create losses, which introduces something called moral hazard. And moral hazard is the enemy of sustainable insurance pricing. 3. Perils versus hazards. A peril is the event that causes the damage: fire, lightning, theft, and so on. Hazard is a condition that increases the likelihood of the peril happening. For example, frayed wiring. That's a hazard. Fire that breaks out because of it. That's the peril. This distinction matters because policies cover perils, not hazards, but underwriters still evaluate hazards to price the risk correctly. 4. There are 2 ways a policy declares what it covers. Named perils. The policy lists the exact causes of loss it covers. If it's not listed, it's not covered. Open perils. Everything is covered unless it is specifically excluded. Open peril policies are broader, but they also flip the burden of proof. In named perils, you prove the loss was caused by something covered. In open perils, the insurer must prove the loss was caused by something excluded. This difference becomes very important when settling claims. 5. Direct versus indirect loss. Insurance doesn't just pay for physical damage. It also pays for the financial consequences that follow. A direct loss is the immediate damage, like a building burning. An indirect loss is the ripple effect, such as lost income during repairs. Property policies handle direct loss by default, while indirect losses often require additional coverage like business interruption. Understanding this helps insureds avoid gaps. How property coverage can be structured. Specific insurance. This is the simplest arrangement. Each type of property gets its own limit. This method is precise and straightforward. If each property stands alone and doesn't fluctuate much in value, specific limits work perfectly. But it has one weakness. Each limit only applies to the property it is assigned to. If you underestimate one location or move stock around, you can easily create a gap. Blanket insurance. Blanket insurance fixes that limitation. With blanket insurance, you combine all covered properties into one single limit that applies anywhere within the insured schedule. If values shift, like moving £10,000 worth of stock from one location to another, you don't suddenly find yourself underinsured at the new location. The blanket limit follows the value wherever it goes. It gives the insured freedom without constantly updating schedules. But blanket insurance isn't perfect. Because it gives so much flexibility, insurers often place requirements or restrictions like coinsurance clauses, mandatory minimum values, added underwriting controls. It's not always available for every risk. It depends on the insured's portfolio quality and the insurer's appetite. Understanding valuation methods helps you explain claims, manage expectations, and avoid disputes. Let's begin with actual cash value, often called ACV. This is one of the most common settlement methods in property insurance, and here's the simplest way to think about it. ACV equal replacement cost minus depreciation. So if a TV costs £2,000 brand new, but it's 5 years old with a 10-year useful life, it's considered 50% depreciated. That means the ACV payout would be around £1,000. ACV is designed to respect the principle of indemnity, keeping the insured financially whole, not better off. Next is replacement cost. This is widely preferred by insureds because it pays the cost of replacing damaged property with new property of like kind and quality, without deducting depreciation. So if a roof is 20 years old and damaged in a storm, replacement cost allows you to install a brand new roof, provided you meet the policy's conditions. Functional replacement cost. Sometimes the original property is outdated, obsolete, or unnecessarily expensive to rebuild. This is where functional replacement cost comes in. Instead of replacing the property with identical materials, the insurer replaces it with something functionally equivalent but cheaper. For example, it gives insureds a fully usable property without forcing them to insure outdated construction at unnecessary premiums. Market value is simply the price a buyer would pay for the property today. Insurance almost never relies on market value for buildings because market value includes land, location, desirability, and other factors unrelated to the cost of rebuilding. The two key exceptions are automobiles. ACV is essentially market value. Stock intended for sale. Finished goods may be valued at selling price. Book value is the historical accounting value. Book value equal cost minus the accumulated depreciation. It has little relevance for insurance because it rarely reflects the true cost to repair or replace damaged property. Agreed value. Some policies include an agreed value option. The insurer and insured agree on the property value upfront. If the insured carries the required amount of insurance, coinsurance penalties are waived. This method simplifies claim settlement and prevents arguments about what the property was worth at the time of loss. Stated value, or stated amount, sets a maximum payable limit for certain assets, most commonly vehicles. It caps the insurer's obligation, even if ACV is higher, to avoid overpayment. Valued policy. A valued policy pays a pre-agreed amount when a total loss occurs, regardless of the actual value at the time of the loss. This approach is often used for fine arts, collectibles, or unique items where determining value after the loss would be difficult. Next, underwriting concepts. Underwriting is the engine room of the insurance company. It's where risks are evaluated, priced, accepted, modified, or declined. Underwriting is the process of selecting risks, assigning rating classifications, and calculating the correct premium. It ensures two things. The insured gets fair and appropriate coverage. The insurer writes the risk at a sustainable profit. An underwriter's job is not just to say yes or no. They look at the nature of the risk, analyze data, talk with agents or brokers, review inspections, and sometimes negotiate terms. Loss ratio. One of the key indicators underwriters monitor is the loss ratio. Loss ratio is equal to losses divided by premium. If a book of business consistently pays out more in claims than it collects in premium, something is wrong. A 50% loss ratio might be excellent in one line of business and average in another. The ratio helps underwriters compare performance, identify trends, and adjust pricing or appetite. Combined ratio. Another important measure is the combined ratio, which includes loss ratio, expense ratio, operating costs. This is the financial heartbeat of an insurer. Types of rating. Underwriters don't price every policy the same way. There are several rating methods depending on the risk. Judgment rating. This is used when risks are unique or complex, meaning there aren't enough similar exposures for statistical comparison. Examples include unusual hazards, new products, or large bespoke risks. The underwriter relies on experience and professional judgment. Manual rating. This is the opposite of judgment rating. Here, insureds with similar characteristics are grouped together and all are charged the same rate. This works well for common risks with large volumes of data. Merit rating. Merit rating adjusts the manual rate based on the individual insured's loss history or risk characteristics. Two main forms. Number 1. Experience rating. Here, the insured's past losses influence the future premium. Better than average loss history discount. Worse than average surcharge. This is used in commercial lines where loss experience is credible and stable. Number 2. Retrospective rating. Retrospective rating looks within the policy year itself. The insured pays an estimated premium at the start. At the end of the year, the actual loss experience is calculated. Good year refund, bad year additional premium. This method gives large commercial insureds a direct financial incentive to manage losses carefully. Hazards. Underwriters constantly evaluate hazards, conditions that make a loss more likely. Physical hazards, construction type, old wiring, location, materials. Moral hazards, dishonesty, exaggeration, fraudulent behavior. Morale hazards, carelessness due to having insurance, I don't need to lock my car. The stronger the hazards, the higher the premium or the stricter the underwriting. Construction types. For property risks, construction type significantly influences fire risk. Here is the hierarchy, from least fire-resistant to most fire-resistant. Frame. Joisted masonry. Non-combustible. Masonry, non-combustible. Modified fire-resistive. Fire-resistive. Better construction means lower premium because it's less likely to suffer severe damage. Now we're going to break down the architecture of an insurance policy, the standard structure you'll find across almost every property and casualty contract. Policies can look intimidating, but once you understand the layout, they become predictable and easy to navigate. 1. Declarations page. This is the personalized part of the policy, almost like the cover sheet of a contract. Here you'll find who is insured, the policy address, the property location, coverage types and amounts, deductibles, policy date, forms and endorsements attached. If you ever want a quick snapshot of what the policy includes, the declarations page is where you look first. 2. Definitions. Insurance uses common words, but often with very specific meanings. For example, bodily injury in insurance means not just physical harm, but includes sickness, disease, and even death. Definitions remove ambiguity. Whenever you see a word in bold or quotation marks inside a policy, that usually means the policy has a formal definition for it. 3. The insuring agreement. The insuring agreement is the heart of the policy. It's where the insurer makes its core promises. In a liability policy, it usually looks something like this. We will pay those sums the insured becomes legally obligated to pay as damages because of bodily injury or property damage. And we have the right and duty to defend the insured. This is the broad framework, and the rest of the policy then shapes, limits, or clarifies this promise. 4. Duty to defend. This means the insurer investigates claims, hires lawyers, pays defense costs, provides representation even if the lawsuit is groundless. And here's the key point. The duty to defend is often broader than the duty to pay. If there's any possibility that a claim might be covered, the insurer must step in until it's proven otherwise. The duty ends only when the policy limits are fully exhausted. 5. Occurrence versus claims made policies. Now let's talk about triggers. What activates coverage? There are two main types. Occurrence policies. Coverage is triggered when the damage occurs, even if the claim is filed years later. Claims made policies. Coverage is triggered when the claim is made, not when the injury occurred. This means a claims made policy may respond to incidents that happened years ago, as long as the claim is made during the policy period and after the retroactive date. 6. Additional or supplementary coverages. Most policies include additional or supplementary coverages, extra benefits automatically built in. For example, debris removal, preservation of property, loss of earnings for attending court, bail bond costs. These add value beyond the main insuring agreement. 7. Exclusions. Every broad promise in the insuring agreement is shaped by exclusions. Exclusions remove coverage for catastrophic exposures like flood, non-standard risks like aircraft, losses covered by other policies like workers' comp, intentional acts. Without exclusions, premiums would be unaffordable. Exclusions define what the policy truly intends to cover. 8 conditions. Every policy has conditions, the rules both parties must follow. For example, reporting the loss promptly, protecting property after a loss, cooperating with the insurer, allowing inspections. If conditions aren't met, coverage may be reduced or denied. 9. Endorsements. Policies change over time. Endorsements are amendments that add, modify, or restrict coverage. Examples include adding an additional insured, changing deductibles, adding coverage extensions, complying with state-specific rules. Endorsements override anything in the main policy wording. Insured types. 1. We have named insured. This is the person or organization explicitly listed on the declarations page. They are the primary holder of the policy, the one the insurer recognizes as the main insured party. If your name isn't on the declarations page, you are not a named insured, no matter who buys the policy for you. 2. First named insured. If multiple people or companies are listed, the first one on the list is given special rights and responsibilities under. The first named insured is the one who receives official notices, pays premiums, requests policy changes, receives cancellation or non-renewal letters. In commercial insurance, this distinction is very important because the first named insured essentially speaks for all other named insureds. 3. Automatic insureds. Policies also protect people who are not shown by name but fall into a defined category. These are called automatic insureds. For example, in a personal auto policy, family members living in the same household may automatically be covered. In commercial policies, employees acting within the scope of their duties might also be automatic insureds. They are included because of who they are, not because they appear on the declarations page. 4. Additional insureds. An additional insured is someone who is not automatically covered and not listed by name, but becomes insured through an endorsement. Other key concepts. Policy period. The policy period is simply the window of time during which the policy provides coverage. It starts at the effective date and ends at the expiration date. Losses must occur during this period for coverage to apply, unless special provisions like retroactive dates or extended reporting apply. Policy territory. The policy territory tells you where coverage applies. For example, many auto and liability policies cover the United States, its territories and possessions, Puerto Rico, Canada. Anything happening outside that territory typically isn't covered unless the policy includes worldwide extensions, cancellation, and non-renewal. Every policy includes rules describing how either party can end the contract. Cancellation. This is termination during the policy term. The insurer usually must refund premium on a pro rata basis. If the insured cancels voluntarily, a small penalty may apply, known as short rate cancellation. Non-renewal. This is when the insurer chooses not to extend the policy at its natural expiration. The insurer must provide advance notice, giving the insured time to secure other coverage. Deductibles. The last concept here is deductibles, the amount the insured must pay out of pocket before the insurer begins paying for a covered loss. Deductibles serve 3 purposes. They reduce small, nuisance claims. They lower premiums. They encourage risk awareness and responsibility. Most are stated as a fixed dollar amount, but some policies use percentages or even waiting periods. Next, we have other insurance. Primary insurance. A primary policy is the policy that responds first when a loss occurs. It pays up to its limit before any other policy steps in. Many policies specify in their other insurance clause whether they are primary. For example, a business auto policy is primary for vehicles the insured owns. A homeowner's policy is primary for damage to the home itself. If two policies both claim to be primary, they must share the loss, which we'll explain in a minute. Next, we have excess insurance. Excess coverage only activates after the primary policy has paid its full limit. The excess policy is not involved in small or moderate claims. It only responds to the large ones. Examples include umbrella policies, excess liability layers, some auto and commercial policies with excess wording. The full excess limit is available once the primary is exhausted. Contribution methods when multiple policies apply. When two or more policies respond at the same level. For example, when two primary policies overlap. The policies share the loss using one of two methods, pro rata by limits. This method divides the payment based on each insurer's proportion of the total available limits. Example: Policy A limit, £60,000. Policy B limit, £40,000. Total limits, £100,000. Policy A pays 60% of the loss. Policy B pays 40%. This is the most common sharing method in property policies. Equal shares. In the equal shares method, each insurer pays the same amount until one of them reaches its limit. For example, Insurer A has £300,000 limit. Insurer B has £100,000 limit. Both pay equally, £100,000 each, until Insurer B's limit is exhausted. After that, Insurer A pays the remaining balance. Equal shares is common in liability policies that support this method. Finally, non-concurrency. Non-concurrency happens when two policies cover the same property or liability exposure, but do not match in terms of coverage triggers, covered perils, policy dates, limits, etc. This mismatch creates gaps. This is why risk managers and brokers work hard to avoid non-concurrency, especially between primary and excess layers. Types of liability limits. 1 per person limit. The per person limit is the maximum amount the insurer will pay for any one individual's bodily injury claim. It doesn't matter how severe the accident is or how many people are involved. Each person can only receive up to the per person cap. This structure is very common in personal auto policies. Next is the per occurrence or per accident limit. This is the maximum the insurer will pay for all injuries or all property damage combined arising from a single event. So whether one person is injured or 10, the same occurrence limit applies. It's the total pool of money available for that event. This is the dominant structure in liability insurance. 3. Aggregate limit. Some policies also have an aggregate limit. This is the maximum amount the insurer will pay during the entire policy period, no matter how many claims occur. Once the aggregate is exhausted, coverage stops until renewal. You will commonly see aggregate limits in Commercial General Liability (CGL), Products and Completed Operations, Garage Liability, Professional Liability, Umbrella Policies. 4. Split limits. Split limits divide liability coverage into separate buckets, typically PD and BI. This structure restricts how much can be paid under each component. Split limits can create situations where the total available money is enough, but one sublimit is too low, leaving the insured exposed. 5. Combined single limit, also referred to as CSL. A CSL gives one single limit that applies to both PD and BI. This offers much more flexibility. For example, a £100,000 CSL can be used entirely for bodily injury, entirely for property damage, or split in any way needed. There are no subcaps, which makes CSL the preferred structure for many insureds. Next, property-specific provisions. There are 3 practical concepts that directly affect how much the insurer pays at the time of a loss: restoration of limits, coinsurance, and the impact of vacancy or unoccupancy. Let's start with 1. Restoration of limits. In most property insurance policies, limits apply on a per-loss basis. This means if you insure your building for £500,000 and you suffer a £50,000 fire loss, the insurer pays the £50,000, and then your limit automatically restores back to £500,000 for the next loss. You don't lose coverage simply because you had a claim. The main exception is any policy with an aggregate limit. In those cases, every payment reduces the total aggregate available, and the limit does not restore until renewal. 2. Coinsurance. Coinsurance requires the insured to carry insurance equal to a specified percentage of the property's value, usually 80%, 90%, or 100%. If the insured carries less than required, they face a penalty at the time of loss. Coinsurance exists to encourage correct valuation. Since most losses are partial losses, the insurer wants to ensure the insured is not deliberately underinsuring to reduce premium. If the insured meets the coinsurance requirement, they receive full payment up to the limit. If they don't, the insurer only pays a portion using the coinsurance formula. This isn't a punishment, it's a pricing fairness mechanism. 3. Vacancy and unoccupancy. Vacancy means the building lacks the property or equipment needed for normal operations. Unoccupancy means the building has contents but no people regularly inside. Vacant buildings have much higher risk: vandalism, fire, theft, and delayed detection of damage. Because of this, many property policies reduce coverage after a building has been vacant for a certain number of days, restrict certain causes of loss, or apply higher deductibles. Now we're going to walk through several important policy provisions that govern rights, responsibilities, and how insurers handle claims and third-party interests. These clauses may seem technical, but they play a huge role in real-world claims handling. 1. Assignment. An insurance policy is a personal contract. That means the insured cannot transfer the policy to someone else without the insurer's written approval. However, after a loss occurs, the insured can assign their right to receive the claim payment, but not the policy itself. The insurer wants the right to decide who they are insuring. That's why assignment without permission isn't allowed. 2. Abandonment. The insured cannot simply give damaged property to the insurer and demand full payment. For example, if a sofa is smoke damaged but repairable, the insured cannot abandon it and insist on a new one. The insurer decides whether property is repaired, replaced, or paid out, not the insured. 3. Subrogation. Subrogation allows the insurer to recover money from the party who actually caused the loss. Here's how it works. The insurer pays the insured for the loss. Then the insurer pursues the responsible third party to recover that payment. This prevents the insured from collecting twice and helps keep premiums stable. Policies also prohibit the insured from doing anything that harms the insurer's ability to recover, such as signing away someone's liability after a loss. 4. Salvage. After the insurer pays for damaged or stolen property, they take ownership of whatever is recovered. The insurer then sells the salvage to reduce the net cost of the loss. Some policies let the insured keep the salvage in exchange for a reduced payout. Otherwise, the salvage belongs to the insurer. 5. Liberalization. It means if the insurer broadens coverage in its standard policy forms, without increasing premiums, the insured automatically receives the improved coverage, even if their policy hasn't been updated yet. It ensures insureds don't get left behind when the insurer modernizes or expands benefits. 6. Mortgage holder clause. If a mortgagee is listed on the policy, they have special rights. They're included on claim payments. They receive notice of cancellation. Their rights cannot be voided by the insured's actions. They can fulfill duties like proof of loss if the insured does not. 7. The loss payable clause is similar but applies mainly to personal property, like vehicles or business contents. A lender or finance company is added as a loss payee, meaning any claim payment must include them. Their financial interest is protected. However, unlike a mortgagee, A loss payee's rights are typically not greater than the insured's. If coverage is void for the insured, it is usually void for the loss payee as well. Finally, we have the bailee clause, often called no benefit to bailee. A bailee is someone who temporarily has possession of your property, like a repair shop, dry cleaner, towing company, or storage facility. This clause prevents the bailee from using your insurance policy to avoid their own legal responsibility. If the bailee damages your property, they remain liable. They cannot hide behind your policy. And that brings us to the end of this course. Thank you for watching, and see you in the next video. Don't forget to like and subscribe.